Okay, good evening and welcome to our taxation. The title of the class for today is Taxation of Specialized Businesses. So, which businesses do we classify as specialized businesses? Now, according to the Company Income Tax Act, there are certain businesses that are classified as special businesses under Section 14 down to Section 17. It includes companies engaged in air and sea businesses. These are foreign companies engaged in air and sea business. So that means if a local company is engaged in air and sea business, it is not a specialized business. So it's only foreign company. So that is specialized business. But if British Airways have a company, have a specialized business. Now we also have foreign companies engaged in cable undertaking. Now, cable undertaking could be communications that are, their cables are passed under the sea and all that. In fact, communication companies in general, like let's say like MTN Nigeria, it's not a Nigerian company, it's a foreign company. Okay, then we have insurance businesses. So both Nigerian companies engaged in insurance and foreign companies. So all in all, insurance business is specialized business. Then we have authorized unit trust scheme. So today we'll be looking at the treatment of air and sea transport and cable undertaking. They are having similar treatment. For the purpose of this class, we will not be talking about insurance business because it's a little bit above air and sea transport business and cable undertaking. Now, when we talk about specialized businesses, we'll look at how do we compute their tax. What is the basis of assessing tax? Of course, since they're under company income tax, it's assessed on preceding year basis. So it's still company income tax, preceding year basis. Okay, but we are going to be looking at two methods of dealing with computation of tax. The first method is what we call the adjusted profit method stroke depreciation ratio method, or simply put, adjusted profit stroke depreciation ratio basis. This is because we will be looking for adjusted profit ratio. We will also be looking for depreciation ratio. Why are we looking for these ratios? Now, for you to understand how this method works, we need to know why we are looking for those ratios. Okay, first of all, what is adjusted profit? Adjusted profit simply means when you have your net profit, you adjust it for all the, let's say you are given a net profit in that statement of account. A lot of things has been deducted. Some of them are allowable for taxation purpose. Some are not allowed for taxation purpose. For example, we have depreciation. It's not allowed for taxation purpose. So when you get all these things, you have to itemize those items that are not allowable, that have already been deducted. You start adding them back. When you add them back, your net profit that was maybe a particular figure, by the time you start adding it back, your net profit will become larger. So you have adjusted your net profits. And so that is what we call adjusted profits. Now, adjusted profit will become accessible profit when we now bring in loss. We now relieve your loss. When we relieve your loss, it becomes accessible profit. That means loss that you incur for the year from other businesses. Okay? So your adjusted profits and your accessible profits could be the same when there is no loss. Okay? So let's say your adjusted profit, there is no loss. By the time you have your net profit, you've adjusted it, it now becomes either adjusted profit or accessible profit. So the next thing to do is to look at capital allowances. Once you have capital accessible profits, the only thing you can take away is profits. So let's come back to adjusted profit ratio. Now you are giving net profits. Now after getting your net profits, you have adjusted it to the point that you have adjusted profits. So what is the adjusted profit ratio? It is the ratio of your adjusted profits all over your total income. So let's say, for example, you have a net profit, you've adjusted it to adjusted profit. That adjusted profit you have now divided by your gross income will give you adjusted profit ratio. Why are we doing it? We want to know the ratio of profits all over income. We want to know how many percent of your profit is from your income, or how many percent of your income is your profit. So let's say your gross income is 100,000 and your adjusted profit is 40,000. Simply means 40 over 100, 40%. Why are we doing that? This is because when you are dealing with foreign companies, you do not tax their activities except what is being done in Nigeria. And so it is by the expenses that they are making us different activities that may cut across different countries. So what we normally do is, instead of bothering with all the expenses that are Nigerian specific, all we do is we look at what we call global income. Global income is, in the eyes of Nigerian tax, it's made up of two parts: Nigerian income and non-Nigerian income. So let's say British Airways have branch in Nigeria, have branch in Ghana, have branch in Britain, and all that. All the income that does not belong to Nigeria are just one. Nigerian income is one. So we have Nigerian income, we have non-Nigerian income. When we add them together, we have what we call the gross income. That's one. Then we have the gross expenses. So we'll bring out all the expenses together. We'll bring all the expenses together and get your total expenses. Then we get our gross net profit. It is that gross net profit that we adjusted to get gross adjusted profit, or global adjusted profit rather. Global adjusted profit. Okay, now we now look for the adjusted profit ratio. I say the global profit before divided by global income times 1. It is this. If in the global scale we have 100,000, and in Nigeria, that is our global income, and Nigeria has just sorry, 100,000. Yes, Nigeria now has 10,000. Okay, now if the profit globally is 40,000, it means 40 over 100, which is 40%. What it means is that our profit is 40% of our income. So if on the global scale, 40% of global income is the profit, that means in Nigerian case, 40% of Nigerian profits should be Nigerian income. So that is it. That is the essence of getting adjusted profit ratio. In the same vein, you will do what they call depreciation ratio. Depreciation ratio is to look at the global depreciation, then divide by your global income. So the steps you are doing under method 1 is to look for, first, look for Nigeria income, which is this. Look for Nigeria income. Then you look for okay, you look for Nigeria income, you look for non-Nigeria global income. Once you know your global income, you have one ingredient to do your ratio. Then you go to your net profit and adjust it to adjusted profits. Then you look for your adjusted profit ratio. Then you look for your depreciation ratio. So these three things, once you've gotten your global income and these two ratios, you are now set to work on Nigerian tax. You come back and say, okay, let's come to Nigerian income. This is Nigerian income once again. You will now use this adjusted profit that you've to find how much is the Nigerian adjusted profit on income. That means Nigeria will also be taking the same ratio, 40% of Nigerian income. So when you've gotten your Nigerian income, then you come to capital allowance. The capital allowance will now be this depreciation ratio. So this depreciation ratio will be used to calculate Nigerian corp capital allowance. That is what your depreciation ratio, which is profit, you less one from the other, you have your total profits. Once you get your total profit, the next thing to do is to charge tax. So now you charge your tax at 30% of your total profits. Now you have to compare that with a minimum tax. What is the minimum tax? 2% of Nigerian income. When you do minimum tax 2% of Nigerian income, you have to choose the higher of CIT, which is company income tax, and MT, which is minimum tax. Whichever one is higher, that is used for the tax. So the minimum tax shows that your tax must not be less than 2% of Nigerian income. So anytime you calculate CIT, always calculate minimum income. The minimum income is the least income, minimum tax rather, is the least tax that that company should pay, as long as it has an income, accessible profits. As long as it has income in Nigeria, not even accessible profit, as long as it has income. So the next thing to ask yourself is, what is Nigerian income? What is Nigerian income? Okay, for an airline and shipping company, the following are Nigerian income. Let me give you an example. For us to understand airline and shipping, let's look at bus and all these buses that they load in the park. Okay, now when they load in the park, let's say maybe you are loading from Oshodi in Lagos State and you are going to Obalende, also in Lagos State. And when you finish loading, the boys there come and collect their dues. They collect their dues because they loaded at Oshodi. When you get to Obalende and drop off your passengers, will the Agboro boys there collect any due for dropping off passengers? No, because where you were loading from is where you make the money. Where you are offloading, that is your destination. You don't make any money there. And let's use that idea. Wherever you are loading your passengers, wherever you are loading your goods, that is where your income is originating. So now the thing is, where is your journey originating? Where is the journey originating? That is where the income is. So if the journey is originating in Nigeria, the income would be from Nigeria. But if the journey is terminating in Nigeria, the income will not be for Nigeria, because the journey must have originated somewhere and terminating in Nigeria. After all, when you are buying the tickets to enter the plane, if you are entering it in Nigeria, you will pay in Nigeria. It's Nigeria that will get the income. So if you are dropping off at London, London is only just welcoming you to ensure that your boarding pass is correct, everything is correct, but they are not making any income because you did not originate that flight in London. So it's a return flight that belongs to them. So even though you book to and fro, the to and fro, the to belongs to Nigeria, the fro belongs to the other country. So you see, sometimes when you are booking to and fro, the price are not the same. Okay. Now, what applies to airline also applies to ship. So origin is what determines the income. Now, looking at cable undertaking, let's look at telecommunication. Let's say MTN, because MTN is a foreign company. If you want to make call and you make a call in Nigeria, that means the call originated from Nigeria. It's a Nigerian income. If you use your own phone line and you roam it and you go to Britain and make the call, okay, the call originates not in Nigeria now, but in Britain. And so you have to use you have to buy credit there, you have to use their their calling system to call Nigeria. So the fact that you called Nigeria does not make it Nigerian income. But that these days now, WhatsApp has taken over the whole thing. WhatsApp, another Facebook call, anywhere you call. So now, what happens is that in this kind of situation, wherever you buy your data, wherever you load, that's why it is prepaid. Wherever you load, that is where they are making the income. So you see, origin, whatever, where you originate the call, where you originate the journey, all of them belongs to the country where the origin of that journey or call comes from. Now, what about if you are in transit? Let's say you load from Senegal and you are going to United States. So Senegal is your originating point. United States is your terminating point. But for some reasons, you now had a stopover in Nigeria and you spent a night or perhaps a day. Then the next day, you continue the journey from Nigeria now to United States. Does any part of the income belong to Nigeria? No, because Nigeria is not the destination. It's just a transit. So anyone you see on transit, it still does not belong to Nigeria. Let's look at a question now to see how we can understand this. Exercise 4.1. The profit and loss account of a foreign airline, Ethiopian Airways Limited, for year ended March 31, 2003 is as follows. Now, look at how you know it's a specialized business. One, you will see it is airline. Once it is airline or shipping, you start suspecting. Secondly, foreign, it clinches it. Now, they have given you the name Ethiopia Airlines. That's fine. Foreign airline, you'll be thinking about specialized business. Now, this is 2003, March 31. It's still going to be preceding year basis. So now let's look at this, even without looking at required, because we know this specialized business. Now, once you know there's specialized business, they will be telling you one of two things. They may be telling you that the FIROS is satisfied with the way the Ethiopian company or the Ethiopian country is handling their tax system. Now, when they are satisfied, that is when method 1 is very, very useful. So this method is used where the FIROS is satisfied that the tax authority of the company's country of origin, 1, computes and assesses a company which operates ship or aircraft on a basis that is not materially different from what Nigeria is doing, and that the FIROS certifies as being applicable to a company in the air or sea transport business. So what they are doing here is they are telling you that they are satisfied that the way Nigeria computes theirs is not different from what the country computes theirs. That's one. They are going to certify this ratio. They are also going to certify this ratio. So once you see a question that, 1, the FIROS is satisfied, 2, they certified this ratio, then you know it's method 1 you are going to use. So now let's forget about all these and let's go and check if they certify it. You are given the following additional information. The FIRS is satisfied. That is what I want to hear. Satisfied. You underline it. That the tax authority in Ethiopia computes and assesses tax on similar basis with Nigeria and has received certification of the appropriate ratios. So you see, satisfied, certification of ratios. These two things is telling you method one. These two things is telling you method one. So let's look at another thing. The tax authority has agreed that the depreciation charged on the accounts can be granted in lieu of capital allowance. What they are telling you is this, that the depreciation and the capital allowances are the same figure. So I've seen the two things I just want to check. So let's come back to this work. Let's look at, can you look at this income? Sorry, can you look at this for income and tell me the figures that are Nigerian income? So go to the chat room now, on the Zoom chat room, not the WhatsApp chat room. Go to the Zoom chat room, Shehu and Tracy, go to the Zoom chat room and give me the figures that are Nigerian income. I'm waiting for you. I believe both of you can see my screen. So give me the figures, either figure or figures that are Nigerian income. Okay, Tracy, I can see you. You mentioned one. There could be one, there could be two, there could be three, there could be four. Okay. All right. So Tracy, you said it's 220. Shehu, you said 220 and 180. Please always be putting your comma, putting your thousand separator. Okay, let's consider it together. Income from passengers freight into Nigeria. So passengers are coming into Nigeria. So if they are coming into Nigeria, it means they must have come somewhere. So the destination is Nigeria. And that makes this 300,000 a non-Nigerian income because it does not originate in Nigeria. Income from goods loaded into aircraft in Nigeria. So it means the aircraft loaded these goods in Nigeria. So that makes 220 to originate from Nigeria. Income from passengers loaded and flown out of Nigeria. So if they are flying out of Nigeria, it means the flight started from Nigeria and they are going out of Nigeria. This makes 180 Nigerian income. Now, income from goods loaded into aircraft on other routes. So it means this one does not even came into Nigeria, nor does it started from Nigeria. This one is not even concerned about Nigeria. So that means we are correct. 220 and 180 belong to Nigeria. So you see, out of this 1,200,000, only 400 belongs to Nigeria. Okay, now when you are going to be solving this, you'll be showing Nigeria income different from non-Nigerian income. Okay, now this is salaries and expenses. Of course, these are allowable. Depreciation, we know they are not allowable. And here they said other disallowable expenses. So we know 120 plus 40, which is 160, is not allowable. But you see this 800, we hope all of them will be allowable. Let's see what the additional information would say. They said salaries and other expenses include, that means there's a problem. Once you hear include, now I want to tell you something. Once you hear comprise and when you hear include, these are two things. Once you hear comprise, that means everything they're going to break down will give you equal to 800. So it is now you that will check which one that is allowed and which one that is not allowed. So when they say comprise, it means they are telling you the breakdown of this whole 800. But when they tell you include, you find out that all the things they are going to tell you including is not up to 800. Just know that everything there requires, what do they call it? It requires adjusted. That means everything is not allowable. Now they said include. So let's look at the things they said include. Deposit for a new VC-10 aircraft, 80,000. So you see this 80,000, it's a capital intensive item. It is not an operational expense, so it cannot be under other expenses. This is a capital item, 80,000. So it is not allowable. That's number one. All my students have gone off. Tracy and Shehu. Let's hold on. Okay. Wow, both of them are back now. All right, I was saying now, let's look at these salaries and expenses. I was saying that if you see the word include, it means the things that they include here will not be up to 800,000. And so all of them need to be adjusted. But when you hear comprise, they will tell you the breakdown of the whole 800,000. Now, deposit for a new VC-10 aircraft. So this aircraft is a capital intensive project. It is a kind of qualifying capital expenditure and not an not an operational expenses. So this 80,000, it's not allowed. Okay, so you're going to add it back. That's one. Payment of 24,000 naira to the Nigerian Port Authority for the use of the VIP lounge at the new Murtala Mohammed Airport by airlines first class passengers. It's not allowed. Payment of 12,000 naira as rent for accommodation used as transit flats by the airline crew. Transit flat. If the transit income does not belong to Nigeria, why would the transit expense belong to Nigeria? So it is not allowed. So these are not allowed. Excuse me. Now, required. Compute the total profit for Nigerian tax purpose. So now, they have not asked you to find tax, so they say total profit. So let's be sure we are answering the question. Now, it is the B part that said income tax payable by the airline. So we will not be going to calculate tax of another country. We are concerned about income tax, company income tax payable in Nigeria. We are concerned here about total profit for Nigerian tax. So look at how we solve this question. First of all, we look at profit for the year. What was the profit for the year? It was how much? 240,000. So that's the net profit. We want to convert this net profit to adjusted profit. So all we need to do is to add all those disallowable expenses that we are not supposed to have deducted. First, chief of them is depreciation. We are told that depreciation is 120, and that's exactly what we did. Then the next one is we are supposed to have done other disallowable expenses, 40,000. So that's this 40,000 here. Then the next thing is that salary and expenses include this. We're going to take care of it here, this 80,000. Then we are going to take care of this 24,000 and this 12,000. So we're going to take care of 24,000 and this 12,000. Now these are all the things that we are going to add back. So when we add all these things back to this 240, our profits that should be subjected to tax or accessible profit or adjusted profit has risen to 516,000. So you see, 516,000 is what we should be having as our adjusted profit. So what do we do? Now that we've gotten our profit, which is the first step, the next step is to look for the adjusted profit ratio. So what's the adjusted profit ratio? You bring your global adjusted profit, which is this figure, divided by the global income. Global income, we've seen it here as 1,200,000. So when we do it that way, we find out that our profit is 43% of our income. That is what it means. Profit is 43% of the global income. We do the same thing for depreciation and say depreciation ratio. We look for that depreciation, which is 120, and divide it by 1,200,000. Converting it to percentage, it means your depreciation, which is in capital allowance, in lieu of capital allowance, is 10% of your profit. And we are told that the FROS are satisfied with these two ratios. Okay, so the next thing to do, so you have all the ingredients. So you have four things. One, you know your adjusted profit, you know the ratio, you have your depreciation, and you know the ratio. So we even have five things, and you have your Nigerian income. So the next thing to do is to bring your Nigerian income. So those two incomes we analyze. So total Nigerian income happens to be 400. Now you double underline it. 400 is your Nigerian income. If the global income of 1,200,000, if the profit is 43%, that means Nigeria income of 400,000, the profit of Nigeria should be 43% of 400,000. That is why we are using the adjusted profits, the adjusted profit ratio. So Nigerian adjusted profit will be the the global adjusted profit ratio multiplied by Nigerian income of 400. It means this 172,000 is 43% of 400. Now this is now your adjusted profit or accessible profit. So now we're not even looking at expenses. Normally it is from income, you less expenses to get your accessible profit. That is, we are not looking at allowable expenses now because we've taken care of it in the global sense. And that is how we got our adjusted profit. So we are less concerned about it now here. So we are looking at 400,000 profit income, 172,000 adjusted profit. Then your depreciation or capital allowance is now the depreciation ratio 10% of 400, which is 40. Do you remember the ratio that time we said it was 10% of 1,200,000, so it was 120, which was 10%. And so the same aspect ratio is still used here, 440. So when you less 40 from 172, you have 132,000 as your Nigerian profit. So this is the total profit that is accessed to tax. So that's the profit access to tax. Then now the tax you are going to be paying is your income tax is 30% of this, which is 39,600. And I told you, you always have to be comparing your CIT with your minimum tax to see if your CIT is bigger than your minimum tax. Look at your minimum tax. Always, it is 2% of Nigerian profit. Why company income tax is 30% of Nigerian total profit. Nigerian total profit, 30% of it. Then why minimum tax is 2% of this. Of course, this 2% of this should be the smallest so far. So if your 30% of this happens to be smaller than 2% of this, it means you have to pay your minimum tax. But if your CIT is higher than minimum tax, you pay the higher. Oh, sorry. Now we've looked at method 1. Method 1 has these characteristics. FRS is satisfied with the tax system calculation. They ratify or certify the APR and the DR. So we use method 1, which is the adjusted profit and depreciation profit method. Now, the second method is the fair percentage rate method. They use this when they are not satisfied that conditions under method 1 is agreeable to them. So when they are not satisfied using method 1, the FRS will now say, we'll have our own special power to determine how much we are going to use as your taxable profits. Your accessible profits. So they use a fair percentage. So they might just say, okay, let's see. We are going to use to charge your accessible profit. So if you see it here, look at your 9. This is the fair percentage that is used to multiply with your Nigerian income to get what they call accessory. You would deduct any capital allowance that is being agreed. Then when you deduct any capital allowance, you now charge your tax. Your charge tax will be 30% of total profit compared with 2% of minimum tax. So that's method 2. When method 1 is not agreeable, the question will tell you that FIROS hereby uses so and so percent. So you know that is the percentage. You will not do anything adjusted profit. You will not do depreciation ratio. They will tell you the capital allowance they agreed. They will tell you the fair percentage. They might tell you the fair percentage is to calculate your accessible profit. They might also tell you the fair percentage to get your total profits. Okay? Now, points to note here. Whenever we use method 2, the company is entitled to say, okay, no, I want you to recompute everything you've done based on method 1. Even though you don't agree with method 1, I demand that you compute it based on method 1. And if method 1 proves to be favorable to the company will say, please compute it on method 1. And they have within 6 months after the year of the relevant assessment to do that, to make their request. So you have computed, if the authorities have computed based on method 2, tell them, no, I want it on method 1, because you must have computed it that way and it is favorable to you. But FRS is saying, no, it's favorable to us to use method 2. You have the right. But after 6 months, you lost that right. All right. Now that we've seen that, let's look at another example, because I've told you about undertaking, cable undertaking. I've told you about that. Okay, so now let's look at exercise 4.2. Okay. Now let's look at Ultimate Limited is a Canadian foreign company. So you've seen the word foreign, you've underlined foreign. Then the next thing to check, engage in cable undertaking. You are not telling yourself special business. And they're doing it in Nigeria. Each worldwide or global, anyone, management accounts for the year ended 30th September 2002, it's preceding year basis, 2003 year of assessment, reveal the following. Now, I want you to give me the Nigerian income here. There are 3 income here that are stated here. Give me the figures that are Nigerian income. I'm waiting for you for the next 30 seconds. Give me the Nigerian income here. Please, good. Okay. Shehu has responded. Tracy, what about you? I believe Tracy had me. What about you? Let me hear your own opinion. Okay, both Tracy and Shehu, you guys got it. So you see, terminating in Nigeria is not Nigerian income. Routed in Nigeria is just passing through Nigeria. It's not Nigerian income, but originating in Nigeria, that's Nigerian income. So out of the 450, 100 belongs to Nigeria. All right, let's look at these expenditures. Salary and wages seems good here, but additional information will tell us otherwise. Depreciation, of course, is going to be disallowed. Overhead expenses seem okay, but we are going to find out. Purchase of equipment, no, no, no. So here we have identified two things. This 39,000 is not allowed. This 90,000 not allowed. So we are going to look at 180 and 85. Now we've seen here, Federal Inland is satisfied. Now we see satisfied is a key word, that the tax computes and assessed in Canada, the country of the foreign company, is the same basis as Nigeria. The Canadian Tax Authority, another keyword, has certified the adjusted profit and depreciation ratio allowance. That means you need to do those allowance, those ratio. Now, included. Now, you see that thing again, I told you, included, not comprised, included in overhead expenses are disallowable expense totaling 23 million. So out of this 85 million, 23 million is disallowed. So we have now three things to add. We are adding back 90, we are adding back 39, we are adding back 23. Okay, now we are told to do three things here. Compute the company's adjusted profits. Of course, that's the sequence of items. That is the sequence of method you are going to do. First of all, look for the company's adjusted profits. Then you now look for the adjusted profit ratio and the depreciation ratio. Then you now go to look for the Nigerian income tax. Now that's what we shall do now. Okay, so let's look at the solution. So this is the net profit that was given to us in the question, 56,000. So we brought it down here. We're adding back those three things we said. 90,000 depreciation, overhead that are disallowable, 23 million, and purchase of equipment, 39 million. You add these three, gives you 152 million. Add it to 56 million, it gives you 208 million. That is your global adjusted profit. That's all. The next one is to look for the ratio. What is the ratio? You need to look at the global income. It was given to us, but just for the sake of emphasis, we brought them down here. 450,000 or 450 million. Now, you now need to do the ratio. Adjusted profit ratio will be this adjusted profit divided by the global income times 100. 46.22%. So your profit is 42.22% of your income. Now we go to depreciation. See that depreciation you added back, 90 million divided by 450 million times 100, 20% of your income is depreciation. Now that you've known these two things, the next question says, compute total profit in Nigeria and tax in Nigeria. So what is your total profit in Nigeria? First of all, you bring your total income. Income is different from profit. Look at your income, total income in Nigeria. As you gave me your answers in the chat room, 100,000. Now you are looking for the Nigerian adjusted profit. So we've calculated APRO 46.22. Use that 46.22 to multiply 100. You get 46,220. Then your depreciation is 20%. Use it to multiply your income. It's going to be 20,000. So all you need to do is 46,220 minus 20,000. Your total profit is 26,220. So in other words, your total profits, we are not looking at the percentage of profits to income. We are just looking at if the adjusted profit is 46%, what is going to be your Nigerian adjusted profit? 46,220. This from here you are lessing your capital allowance, and this is what you are getting. After getting this, the next thing to do is to compute your tax. So the first thing to do is to look for your income tax 30% of this figure, and that's this. Then the minimum tax 2% of 100,000. And you get 2,000. So you choose the higher of the two, which is this. So you see, in all these two methods, the FROS are satisfied. So, but you see, when they are not satisfied, FROS will give you a thought to be used. They might also ask you in this situation occurred, not giving you a question to solve. So, my dear friends, this is what we call special businesses. Don't forget, special businesses are foreign companies involved in airline and shipping cable undertaking in Nigeria. Also, we have insurance company, both Nigeria and local and foreign insurance company that are doing life insurance and non-life insurance. Then we have trust and unit scheme, authorized trust and unit schemes. These are some special businesses in Nigeria. I don't know if at this point you have any questions. So let's take the next 2 minutes to treat question. Class will end by 8:30. So let's use the next 2 minutes to treat, or the next 1 minute now. If you have no question, okay, go through. I'm going to send the note later today, this night, so that you have your own copy, so that you can go through it. And if there's any question, feel free to ask me. After I end the class, latest before 9 o'clock, you will get your notes. All right? Any question should be channeled to the WhatsApp class now. So thank you so much for coming to class. At this point now, we want to say thank you and stay well.